There is a number. It is not $1 million. It is not enough to retire one. It will not buy you a house, a boat, or even a decent used car in this economy. But something strange happens when you reach it. The rules change. Not the rules of the market, not interest rates, not government policy. The rules change for you. The way you think, the way you spend, the way other people treat you financially, and the way entire system responds to your existence. That number is $10,000, and almost nobody talks about what actually happens when you get there. Let's be honest about where most people are starting. The most recent data shows that the median American family has about $8,000 in liquid savings. Not invested, not locked in a retirement account, just accessible money. Money you could actually spend if something went wrong. For half the country, the $10,000 in savings is still a destination they have not reached, which means the moment you cross the threshold, you are no longer in the statistical majority. You have left a very crowded room, and what nobody warned you about is that the room you just entered has completely different physics. To understand what changes at $10,000, you need to understand what life looks like below it. When you have very little savings, let's say under $1,000, you're not just broke. You're operating in a completely different financial system than people with money. Your bank charges you fees that wealthier customers don't pay. Minimum balance fees, overdraft fees, monthly maintenance fees. The Consumer Financial Protection Bureau estimated that Americans pay roughly $15 billion a year in overdraft fees alone. That is a tax on being poor. It is invisible, it is legal, and it compounds relentlessly. Your credit score reflects your scarcity. Because you cannot afford to let your credit utilization drop, and because you have no buffer, you are perpetually penalized for a condition that the scoring model helped create. You cannot negotiate. If a landlord asks for 2 months deposit and first month's rent, you either scrape it together or you lose the apartment to someone who had the money already sitting there. If your car needs a repair, you either pay the mechanic's price today or you lose the job you need to pay for the repair. You're not making worse decisions because you're a worse person. You're making worse decisions because the problem takes up too much space. And then something starts to shift. The first $1,000 saved feels almost meaningless. You know it won't cover a major car repair. You know it won't survive a medical bill. It sits in your account and you're vaguely aware that one bad week erases it entirely. But something subtle happens anyway. A small, almost imperceptible change in how you respond to small emergencies. The $300 surprise doesn't ruin the month. That single shift, that buffer, begins to interrupt the feedback loop that was keeping you exactly where you were. From 1,000 to 5,000, the emergencies that used to end your progress stop ending your progress. You're not yet wealthy. You're not yet safe in any meaningful sense. But you're no longer being systematically set back to zero by every unexpected event. This is not a metaphor. It is literally the math. From 5,000 to 10,000 is where something strange begins to happen. And it is not just financial. It is psychological. And it is where the actual story starts. Here is a concept that almost no personal finance content talks about honestly. There is a point below which money behaves like a consumable. You spend it, it is gone. You earn more, you spend more. The relationship between you and your money is transactional and immediate. Above a certain threshold, money starts to behave differently. It starts to generate options that actually change a life. At $10,000, something specific happens to your decision-making architecture. You stop making decisions from desperation and start making them from choice. That sounds like a motivational poster, but it is not. It is a cognitive and practical distinction with measurable consequences. For example, if your landlord raises the rent and you have $400 in savings, you have one option. You pay it. When you have $10,000 in savings, you have six. You pay it, you negotiate, you start looking for a new place from a position of stability, you buy time, you explore ownership for the first time, or you simply refuse and give notice without immediate catastrophe. The number of options you have in any given financial situation is in direct proportion to your liquidity buffer. And the difference between 0 options and 6 options is not just convenience. It's the difference between a life that is controlled by external circumstances and a life where you have some meaningful control over outcomes. This is what people mean when they say money buys freedom. They are not talking about yachts. They're talking about not having to say yes to something bad because you have no alternative. The financial industry, like credit and lending systems, is built on a fundamental assumption that you need them more than they need you. When you have no savings, that assumption is correct and they charge you accordingly. The average interest rate on a credit card as of April 2026 was 21.5%. If you carry a balance of $5,000 on that card for 1 year, you pay over $1,000 in interest alone. That is the cost of not having savings. It is not a fee, it is not a penalty, it is simply what happens when you need money and do not have it. You rent it from someone else, and renting money is among the most expensive things a person can do. Now let's flip it. When you have $10,000 sitting in a high-yield savings account, and as of April 2026, many of these accounts are paying between 3.5 and 4%, that $10,000 earns you roughly $350 to $400 a year in interest. That is not a life-changing sum, but notice what just happened. The system that was extracting money from you because you had none is now paying you because you have some. The same financial infrastructure, the same banks, the same interest rate environment. But your relationship to it has inverted completely. Below the threshold, the system takes from you. Above the threshold, the system pays you. This is not a luck. It is not a reward for good behavior. It is the mechanical, indifferent logic of capital. Capital attracts capital. Scarcity attracts cost. The system is not designed to be cruel. It is simply designed to be profitable. And for a very long time, you were the product. Here's the part that the compound interest charts in personal finance books never show you. Everyone has seen the graph. The one where $10,000 invested at 7% for 30 years turns into $76,000. The line curves upward. It looks beautiful. It looks inevitable. What they don't show you is the zero line. Millions of people reach retirement age 65, 67, 70, having never accumulated the initial sum required to start the curve. They spend decades not above the threshold but below it, paying overdraft fees, paying credit card interest, paying the financial penalty for having no buffer. And while one person's $10,000 was curving towards $76,000, theirs was being extracted dollar by dollar in fees and interest and the cost of emergencies they could not absorb. The gap between those two people is not talent, it is not discipline, not entirely. It is often simply a starting point, the presence or absence of a cushion, an inheritance of $5,000, a year without a medical crisis, a job that paid just slightly more than the bills. There is the uncomfortable math. Wealth doesn't just grow, poverty compounds too. When you cross $10,000, a door opens that was not previously available to you. And most people walk past it because nobody told them to look. That door is the stock market, not in a get-rich-quick sense, but in the mechanical index fund let capitalism work for you sense. The S&P 500 index that tracks the 500 largest American companies has returned an average of roughly 10% per year over the last century. Not every year. Some years it falls 30%, some years it rises 25%, but across long enough time horizons, the average has held. If you have no savings, that is theoretical. You cannot invest rent money. You cannot invest your emergency fund if having it invested means you cannot access it quickly. The market is genuinely inaccessible to you, not because of fees, but because of risk tolerance. A person with $400 in savings cannot survive a 20% market correction. A person with $10,000 in a savings account, fully liquid, separate from their investments, they can put $3,000 or $4,000 into the market and actually leave it there long enough for it to matter. That is the sequence: emergency fund first, then investment. And the emergency fund is not a stepping stone. It is the entire foundation. Without it, every market downturn becomes an emergency that forces you to sell at the worst possible time. Here is something that almost nobody talks about. Saving $10,000 changes the way you think about money permanently, not because of some spiritual transformation, but because of the exposure. Before you have savings, money is a flow. It comes in, it goes out. You manage the flow. You think about money in terms of monthly cycles. Can I make it to payday? Can I cover this bill? Can I afford this thing? When you have a balance, a real meaningful balance that you have watched grow, your relationship to money becomes structural rather than sequential. You start thinking in terms of what you own rather than what you owe. That is a completely different mental model, and it changes the decisions you make going forward in ways that are hard to reverse. People who have had savings then lost them describe feeling like they understood money differently afterward. Even in scarcity, they retained a mental model of abundance that people who had never crossed the threshold often lacked. This is not a guarantee of future wealth. People lose savings all the time. Medical debt, job loss, divorce, the list of mechanisms that can return you to zero is long and depressingly mundane. But the cognitive upgrade appears to be persistent in a way that the money itself is not. Let's take a moment to acknowledge the absurdity here. The hardest part of the $10,000 is not going from $9,000 to $10,000. It is going from zero to $1,000. Everything after the first thousand is incrementally easier, not because savings become simpler, but because the emergencies that used to reset you to zero are now survivable. But society has designed a system in which the people most need the cognitive and practical benefits of having a savings cushion are the people for whom accumulating one is functionally impossible on a month-to-month basis. If you earn $35,000 a year, a salary that in many American cities barely covers rent and basic expense, the conventional advice to save 20% of your income is not advice. It is arithmetic fiction. 20% of $35,000 is $7,000 a year. After taxes, you might take home $28,000. That is $2,333 a month. If rent is $1,400, utilities $150, food $400, transportation $300, you are at $2,250. You have $83 left. Saving 20% of that would take you 120 years to reach $10,000. The advice is not entirely wrong. It is just written for a different person than the one reading it. What you are really talking about when you talk about the $10,000 threshold is the architecture of economic mobility. Here is the uncomfortable reality. The financial system is a system of leverage. Leverage means using what you have to get more. The people with the most leverage get the most out of the system. The people with the least leverage pay the most to participate in it. The credit card company doesn't offer 21% interest to wealthy people. It offers them 0% promotional rates and cashback rewards and travel points. It offers 20% to the people who need the credit most. That is not irony. That is product design. The rental market does not ask wealthy people for 2 months security deposit. It asks you because a wealthy buyer can purchase the asset outright. You need to rent it, and renting housing, money, transportation is always more expensive per unit than owning. Over a lifetime, the cost of not having capital is staggering. Here is what is true. $10,000 is not a magic number. It is a rough proxy for a concept, the minimum viable financial cushion that begins to change the math of your daily decisions. For some people, that number is $6,000. For people in expensive cities, it might need to be $15,000 to have the same effect. But the threshold concept is real. There is a point, and you probably know it when you're below it, where money feels scarce in a way that costs you money. And there is a point where the same system that is extracting from you begins in small but compounding ways to work in your direction. The question is not whether the threshold exists. The question is how to get there from wherever you are. And that answer is almost never found in the same advice given to everyone, regardless of income, regardless of circumstance, regardless of what city they live in or what their childcare cost or what their student loan payment is. The personal finance industry has a complicated relationship with that reality. Here is where I'm going to leave you. There are two ways to interpret everything you just heard. The first interpretation is optimistic. There is a threshold. It is reachable. Once you cross it, the mechanics of your financial life genuinely improve. The system starts working with you instead of against you. It is hard to get there, but it is worth the effort, and the effort compounds. The second interpretation is less comfortable, a system that charges the most to the people with the least, that rewards capital with more capital, that makes it hardest to climb for the people who most need to climb. And whether your $10,000 moment changes your life, or whether a medical bill, a layoff, or a family emergency returns you to zero before you ever got to feel what the other side was like, that is not entirely a function of your choice. The threshold of $10,000 is real. Whether you can reach it is a different question. And the answer to that question says a lot less about you than the financial industry would like you to believe. I hope this video is helpful. I hope it was valuable to you. Please don't forget to share and subscribe, and I'll see you in my next one.